Okay, let's do a little mental exercise. I want you to picture this.
Hmm.
It is Wednesday, February 11th, 2026. You are the CEO of a massive, household name tech company.
Right.
You've just handed in your report card for the last quarter, and honestly, it's a thing of beauty.
We're talking the kind of report card you'd, like, put on the fridge.
Exactly. You're making way more money than you did last year. Your profits are up.
Yeah.
The specific things you tried to sell, like getting people to rent apartments or get mortgages through your app, they are absolutely flying off the shelves. The strategy is working.
It sounds like a victory lap is in order.
Mhm.
Champagne corks popping, investors cheering, the whole 9 yards.
That is exactly what you would think. But welcome to Wall Street. Because instead of a celebration, by the time the closing bell rings, your stock hasn't just dipped.
No.
It has tanked.
Yeah.
We are talking a nosedive of over 17%.
Wow.
You've lost nearly a fifth of your company's value in a single trading session.
That is a nightmare scenario for any executive. And frankly, for the investors holding the bag, it's a huge splash of cold water.
It's not a hypothetical, though. This is exactly what just happened to Zillow group tickers ZG and Z, and that is what we are unpacking today. We're calling this the Zillow paradox. How can a company's numbers look so good, yet the market reaction be so incredibly bad?
It really is a fascinating case study in market psychology.
Right.
Because what we're seeing here isn't just a math problem. It's a conflict between the present and the future.
Right.
It's a clash between current performance, which, as you said, was strong, and future fear.
And fear is a very powerful motivator. So our mission today is to figure out how Zillow lost roughly $9.32 per share in one day, landing at a price of $45.10 despite what looks like a really healthy business on paper.
Yeah, we need to bridge that gap.
Yeah.
And to understand the crash, we first have to give credit where it's due. We have to look at the good news deception, if you want to call it that. Because if you just glanced at the headline numbers for Q4, you'd be scratching your head wondering why everyone is selling.
Okay, so let's look at the scoreboard first, the actual numbers.
Let's do it. Zillow reported total revenue of $654 million for the quarter.
And context is key there. That is an 18% increase year over year.
18%. In a mature market, that's nothing to sneeze at.
Not at all. That is serious double-digit growth in real estate, which has been, so volatile.
Absolutely. But it's not just the top-line number that's interesting. It's where that money is coming from. That's where you see the strategy actually working.
I was looking at the breakdown, and the rental market stood out to me immediately. It seems like that's where the real action is.
It's the star of the show right now. Rental revenue jumped 45%.
45.
Yes, to hit $168 million. Think about that for a second. Nearly 50% growth in a single segment.
It tells you that Zillow isn't just a place people go to daydream about mansions anymore.
Exactly. It's becoming a utility.
That's a huge distinction. A utility implies people need it, not just like it.
Precisely. Landlords are paying to list. Renters are engaging to apply. It's moving from just an entertainment platform, Zillow surfing, to real infrastructure.
And it wasn't just rentals, was it? Mortgages also seemed pretty strong.
Yeah, even mortgages, which is usually the scary part of the business when rates are all over the place.
Right.
Mortgage revenue increased 39% to $57 million. And this is crucial because for years, the big criticism of Zillow was that it was a top-of-funnel business.
Okay, so let's unpack top of funnel for people who might not live in marketing land. That basically means lots of eyeballs, but not a lot of wallets opening.
That's it exactly. It's the window shopping problem.
Yeah.
You have millions of people browsing, looking at the pretty kitchens and backyards, but are they actually transacting?
Are they spending money? And according to this report, the answer is finally yes.
The CEO, Jeremy Waxman, and CFO, Jeremy Hoffman, they actually addressed this directly. They said, quote, consumers are increasingly choosing Zillow to help them move from discovery to transacting.
Discovery to transacting. That's the corporate speak for they stopped just looking at pictures and started actually signing leases and getting loans.
That's it. And that is the holy grail for a platform like this. You want to capture the transaction, not just the ad impression.
So, okay, revenue is up. The core business model is proving itself with that huge rental growth. But what about the bottom line? Was this profitable growth?
It was. This wasn't growth at all costs. Their profitability metrics improved a lot. If we look at adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization.
Right.
It climbed 33% to $149 million.
So a 33% jump in profit, That's outpacing the revenue growth, which means they're getting more efficient?
That's operating leverage right there. And I saw the growth margins are sitting at a very healthy 74.14%.
74% margins. That's software territory. That's elite.
It really is. So in a normal world, if I told you a company grew revenue by 18%, profit by 33%, and had 74% margins,
You'd expect the stock to go up, right?
you'd expect investors to be thrilled. In a vacuum, those are home run numbers. They suggest a highly efficient growing machine.
So this is where it gets really interesting, or I guess really painful if you own the stock.
Yeah.
If the past quarter was so good, why did the stock plummet to $45.10? I mean, we're looking at a 52-week range where the high was over $90.
It's been cut in half from its peak, and this one day did a lot of that damage.
It's the Zillow paradox. Why does the market hate this report?
This is where we have to pivot from the spreadsheet of the past, what they already did, to the crystal ball of the future.
What they think is going to happen.
Right. The catalyst for this crash wasn't what happened in Q4. It's what Zillow told us is going to happen in 2026.
And looking through the report, there was one specific word that kept popping up, the word drag.
Yes, the drag on earnings. And the source of that drag isn't a housing crash or a lack of customers.
Right.
It's lawyers.
Legal costs.
Legal costs. Zillow explicitly stated that legal battles would weigh heavily on their earnings throughout 2026. The whole real estate industry has been under a microscope for a while now about commissions and antitrust issues.
Right. The way agents get paid, how listings are displayed, all of that is being challenged. And lawsuits are not cheap.
They are incredibly expensive. And here's the key point for an investor. Unlike investing in a new product or marketing money spent on legal defense, doesn't generate future revenue.
It's dead money.
It's a defensive burn of cash. It's money you spend just to stay where you are. It doesn't help you grow. And Wall Street hates that.
So investors saw this legal drag and just panicked.
It wasn't just the concept. It was the specific numbers Zillow gave for the next quarter. This is what we call the guidance gap.
Okay, let's run the numbers on this gap because I want to understand if the punishment fits the crime here. What did Zillow say they were going to do in Q1?
Management predicted Q1 revenue between $700 million and $710 million.
That actually sounds okay on the surface.
It does. Yeah. But then they gave the profit forecast. They predicted adjusted EBITDA between $160 million and $175 million.
Okay, $160 to $175 million in profit. Got it. And what did Wall Street want? What was the expectation?
The analysts, the people whose job it is to monitor these things, they were looking for about $184 million.
So, wait a second. Let me do the math here. The difference between the top of their guidance, $175 million, and the expectation, $184 million, is only $9 million.
Right.
And on the lower end, maybe a $24 million miss.
Correct.
And that, like, $10 to $20 million gap caused the company to lose 17% of its value.
Billions of dollars in market cap wiped out.
That seems disproportionate.
It does seem extreme when you put it that way, doesn't it?
Yeah.
But you have to understand the market psychology. It's not just the $15 million. It's the reason for the $15 million.
The uncertainty.
Exactly. When a company misses because they sold fewer widgets, you can model that. But when a company says legal costs are going to hurt us, the market hears, we don't know how bad this is going to get.
It's the fear of the unknown. It's a black box.
Precisely. Investors hate bad news, but they absolutely loathe uncertainty. If Zillow had said, we have to pay a one-time fine of $50 million and then it's over, the stock might have actually held up better.
Really? Even though $50 million is way more than the miss.
Probably. Because a fine is a known quantity. It's a line item. You pay it, you move on. But ongoing legal costs? That feels like a black hole. Is it going to be $20 million? $50 million? $100 million? For how long?
So the market thinks, if the lawyers get more expensive next month, does that guidance drop to $140 million? When does the bleeding stop?
That's it. And because they can't answer that question, they discount the stock. They aren't willing to pay a premium for earnings that might get eaten up by litigation.
So the market is basically saying, we don't care that you grew profit 33% last quarter. We are fixated on the missing millions in the next quarter.
That's the so what here. The market is a forward-looking mechanism. It doesn't pay you for what you did yesterday. It pays you for what it thinks you'll earn tomorrow. And right now, Wall Street sees a big question mark labeled litigation.
It's amazing how quickly the sentiment turned. I was looking at the trading volume. Usually, Zillow trades about 867,000 shares a day.
Right. Pretty standard.
On this day, February 11th, volume spiked to 3.1 million.
That is nearly 4 times the average. That is a massive sell-off. That tells you this wasn't just a few retail traders getting nervous.
No, that's institutional money, the big guys. Pension funds, mutual funds.
Exactly. That is funds heading for the exits because the risk profile of the stock changed overnight. They looked at the legal uncertainty and said, we can't hold this right now. It's too risky.
It's like everyone rushed for the door at the exact same time.
And when everyone rushes for the door, the price collapses. It's classic supply and demand.
It's now hovering right near its 52-week low. It just wiped out months of progress in hours.
It is brutal. And it's a difficult situation for the company because operationally, they're doing everything right.
Right.
The business model works. The machine is built.
But the stock is being held hostage by these non-operational factors.
That's a great way to put it. Operational versus non-operational. Operationally, the engine is purring. The car is fast.
Yeah.
But non-operationally, the driver is getting pulled over for speeding tickets every 5 miles.
That's a fantastic analogy. And for the passenger, the investor, it doesn't matter how fast the car can go if it keeps getting stopped. The arrival time gets delayed.
And the passenger starts thinking, maybe I should get out and take a different car.
Let's go back to the rental thing for a second, because the legal stuff is overshadowing just how significant that 45% growth is. You called it becoming a utility.
Yes.
If Zillow can actually lock in the rental market, doesn't that create a long-term moat that protects them?
It absolutely does. And that's the bull case, the optimistic view hidden in this report. If you're a landlord getting all your leads through Zillow, you aren't going to leave just because Zillow has some legal fees.
You're kind of stuck there.
The network effect is massive. So underneath the stock crash, the actual business is getting stickier and stronger.
So if you're listening, this Zillow story is a perfect example of why good numbers don't always mean good stock performance.
It's a reminder that you have to read the whole report. You can't just stop at revenue up 18%. You have to look at the guidance. You have to look at the footnotes. Because in this case, the baggage weighed more than the cargo.
The baggage weighed more than the cargo. I like that.
Yeah. And now the company is in a show-me state. For the rest of 2026, Zillow has to prove 2 things. 1, that they can keep growing that core business.
Keep the engine running.
And 2, that they can navigate these legal headwinds without blowing up the balance sheet. Until that uncertainty clears, that drag is going to act like an anchor on the stock price.
It's a fascinating disconnect. It challenges the idea that stock prices are purely rational reflections of business health.
Sometimes they're just reflections of anxiety, and anxiety is a very expensive emotion in the financial markets.
So let's recap our deep dive. Point 1, Zillow is crushing it on the operational front.
Revenue up 18%, rentals up a massive 45%. They're successfully converting window shoppers into actual customers.
Point 2, they are profitable.
Adjusted EBITDA up 33%. Margins are great. They are making money.
But point 3, the market hammered them down 17% because of the future.
Because the cost of doing business in a litigious environment is eating into their forecasts. And the market hates not knowing how big that bill will be.
It's a harsh lesson. You can build a better mousetrap, but if you have to spend all your profit defending the patent on it, Wall Street isn't going to be impressed.
That's the reality.
So we'll leave you with this final thought to mull over. We saw a company grow its core business by nearly 50% in key areas like rentals. Yet, it lost 17% of its total value in 6.5 hours due to legal fees and a forecast miss.
It really raises the question, if you were looking at Zillow right now, does the stock price actually reflect the value of the business and its technology? Or right now, does the price just reflect the high cost of its lawyers?
Is it a bargain or a trap? Something to think about next time you're scrolling through house listings on your phone at 2 a.m. Thanks for diving in with us.
See you next time.